Welcome back to the Daily Crypto Roundup, the show that brings you clarity, confidence, and context every single day, even when the markets don't make it easy. And today, we've got a really interesting one, because the last 24 hours have been a perfect snapshot of how this market behaves when fear and fundamentals clash head-on. We've had regulatory pressure in Asia, a sharp overnight bounce across the majors, hints of returning liquidity, and a few signals that suggest the shakeout we saw earlier in the week may not be the warning shot people thought it was. If anything, it might have been the reset the market needed. Before we jump in, a huge thank you to everyone who continues to rate the show 5 stars and keeps supporting what we're doing here every day. Remember, the Friday XRP giveaway is running. 10 XRP to the comment of the week, another 5 XRP to a random listener. We'll reply directly to the winners and send the XRP over. So if you haven't rated the show yet, it honestly makes a massive difference. Now, let's settle in, because today's show has a lot of moving parts. But before we break any of this down, let's call the board. Because you know the drill. The numbers tell the truth even when the narratives don't. Bitcoin, the anchor of everything, is sitting just shy of $92,000, holding that bounce we saw develop late last night. Ethereum is back above the $3,000 mark, which is a massive psychological line for traders, analysts, and even institutions that have been waiting for market structure to return. XRP sits at 217, Dogecoin is trading around 14.5 cents, Solana is holding firm around $139, Cardano is at 43 cents, Polkadot trades around $2.25, and BNB continues to hover near the $880 region. So prices are stable. The board is green. Liquidity looks a touch healthier than it did yesterday. And now we get to the conversation that really matters. Why? But the real turning point, the moment the switch actually flipped, came during the Asian trading session, when Japan's government bond auction came in far stronger than expected. That single event immediately calmed fears that the Bank of Japan was about to tighten aggressively, which had been one of the key macro pressures weighing on crypto, tech stocks, and all risk assets over the last 48 hours. As soon as yields dropped and bond markets steadied, futures across equities turned green, and Bitcoin began lifting almost instantly. That relief in global yields was the spark the confirmation traders needed, and it triggered a wave of short covering and re-entry buying. One analyst at Reuters said the auction removed the panic tail risk that had been suppressing liquidity, while another described it as the macro green light the market was waiting for. And once that switch flipped, everything lined up. ETF outflows slowed, forced liquidations had already cleared, and risk appetite returned all at once. That's why the bounce was so sharp. It wasn't random, it was triggered. The pressure came off the system in one moment, and buyers moved back in immediately. Now, before we get into this next story properly, I want to make something really clear. We intentionally left this out of yesterday's episode. That wasn't an accident. It wasn't a miss. It was a judgment call. When the market is falling rapidly, confidence is fragile, and people are already overwhelmed with noise. The last thing you want to do is pile on even more fear, especially when you don't have enough data yet to understand how Asia is going to react. We suspected we'd see a bounce today. We suspected the sell-off would be followed by a stabilization phase. But we wanted to see how the Asian session handled this Hong Kong situation before we brought it to you. There's no value in panicking people with half the picture. So we waited. We watched. And now that liquidity has returned and the market has calmed down, we can talk about this properly and tell you why it mattered so much. So here's the full story. Hong Kong, which has spent the entire year positioning itself as a regulated crypto hub for Asia, just had its foundations shaken again after the People's Bank of China issued new guidance and commentary around virtual assets and stablecoins. Several Hong Kong-listed companies with stablecoin exposure saw their shares drop sharply after Beijing signaled that it intends to intensify oversight of anything that blends traditional finance with digital assets. On the surface, the headlines didn't look catastrophic. They didn't scream crisis. But the impact behind the scenes was far more significant than the headline suggested. And here's why. Hong Kong, Singapore, and Japan make up the core of early session liquidity for crypto. Before Europe wakes up, Before the US turns its machines on, before the ETFs kick in, Asia sets the tone. For years, stablecoins have been the fuel behind that early session volume. Arbitrage, cross-exchange flows, trading desks rebalancing positions, and offshore capital rotating in and out. So when the People's Bank of China signals concern around stablecoins, even if it's aimed at domestic usage, traders react by stepping back. Order books thin out, market makers reduce risk, liquidity dries up. And that, right there, is how you get exaggerated overnight price action. Combine that with thin liquidity from US Thanksgiving. Combine it with ETF outflows. Combine it with tech stocks falling. And you get exactly the environment we saw during yesterday's drop. The Hong Kong stablecoin pressure didn't cause the dip, but it magnified it. It amplified the weakness at the worst possible moment. And because we didn't know how Asia would handle it until we saw this morning's data, we chose not to include it in yesterday's show. Today, thankfully, we know exactly how they handled it. Calmly. Liquidity returned. Market makers stepped back in. Stability followed. And the rebound you're seeing right now is a direct reflection of that. And just before we move on from this Hong Kong situation, it's important to understand what it means going forward. This wasn't a ban, and it wasn't a crackdown in the dramatic sense. But it was Beijing reminding the market that stablecoin activity in Hong Kong is going to be watched much more closely. And when Asia feels watched, liquidity always gets thinner. That means early session trading could stay more sensitive for a while, with smaller headlines creating bigger moves until confidence resets. It also means cross-border flows between Hong Kong, Singapore, Japan, and the mainland will face more caution from market makers. None of this is catastrophic, but it does shape the tone of those crucial first few hours of every trading day. And now that we know how the market absorbed it, it gives us much more confidence in today's rebound than we had 24 hours ago. And on that note, we're going to take a quick break. Stay with us. Because after the break, we're going to explain why this bounce is more than just a dead cat move, what institutional signals we're watching today, and the story out of Vanguard that could end up being one of the most underappreciated developments of the entire week. Back in a moment.
Avoiding your unfinished home projects because you're not sure where to start? Thumbtack knows homes, so you don't have to. Don't know the difference between matte paint finish and satin? Or what that clunking sound from your dryer is? With Thumbtack, you don't have to be a home pro. You just have to hire one. You can hire top-rated pros, see price estimates, and read reviews all on the app. Download Thumbtack today.
What can 160 years of experience teach you about the future? When it comes to protecting what matters, Pacific Life provides life insurance, retirement income, and employee benefits for people and businesses building a more confident tomorrow. Strategies rooted in strength and backed by experience. Ask a financial professional how Pacific Life can help you today. Pacific Life Insurance Company, Omaha, Nebraska, and in New York. Pacific Life and Annuity, Phoenix, Arizona.
Since 2011, American Giant has been making everyday clothing with extraordinary effort. Not in far-off factories, but right here in the USA. We obsess over fabrics, fit, and details, because if you're going to wear it every day, it should feel great and last for years. From the cut of a hoodie to the finishing of a seam, nothing is overlooked. Our supply chain is tight-knit and local, which means less crisscrossing the country and more care in every step. The result is durable clothing, t-shirts, hoodies, sweatpants, and denim that become part of your life season after season. This isn't fast fashion, it's clothing made with purpose by people who care as much about how it's made as how it fits. Get 20% off your first order with code STAPLE20 at American-Giant.com. That's 20% off your first order at American-Giant.com with code STAPLE20.
Welcome back. And if you stayed through the break, good. Because this next segment is where things start to stitch together. Before the break, we broke down what happened in Hong Kong, why we held it back yesterday, and how it contributed to the overnight fragility. But now we need to talk about why the bounce today happened so quickly, and why the structure behind the rebound matters more than the rebound itself. Let's start with something subtle but important, the liquidations. Yesterday, We saw nearly $1 billion in leveraged positions wiped out. That reset the entire derivatives landscape. And whenever leverage gets flushed out like that, markets tend to stabilize faster, because the forced downside pressure disappears. When you combine a leverage reset with returning liquidity from Asia and calmer ETF flows from the US, you often get exactly what we're seeing now, a sharp recovery, followed by a period of steadiness. And that brings us to the institutional side of this narrative. One of the most interesting developments in the last 24 hours didn't come from crypto Twitter. It didn't come from a trading desk. It came from Vanguard, one of the biggest asset managers in the world, quietly allowing access to certain crypto ETFs. Now, this isn't a full turnaround. Vanguard isn't suddenly becoming a crypto company, but they're opening their doors enough for retail and certain clients to get exposure to Bitcoin, Ethereum, XRP, and Solana through ETF vehicles. And you might ask, why does this matter today, of all days? Because institutional access is the quiet backbone of market cycles. When big firms expand access during volatile periods, it signals something. They're not scared of the long-term picture. They understand the difference between structural weakness and temporary pressure. They don't panic when liquidations hit the market, because they know what's behind them. And on top of that, we've now got crypto-adjacent equities rallying as well. Companies with indirect exposure to Bitcoin and Ethereum, firms that hold digital assets on their balance sheet or operate infrastructure around them, are seeing strong relief today. Again, this lines up perfectly with what we said yesterday. The drop wasn't fear-driven, it wasn't long-term holders giving up, and it wasn't smart money exiting the market. It was mechanical. Even analysts who have been bearish for months are starting to admit something similar. This looks like a reset, not a reversal. And that shift in tone matters. But there's one more angle we need to cover today: altcoins. Because the rebound hasn't been isolated to Bitcoin and Ethereum. We're seeing early signs of rotation in XRP, Solana, Cardano, and even in some higher-risk names like SHIB. These aren't bull market breakouts, they're not euphoric surges, but they are the early tremors of liquidity redistributing back into higher beta assets, which almost always happens after a market flush, not before one. When a cycle is ending, alts die off completely. Liquidity dries up permanently. Things go quiet. Today, we're seeing the opposite. Early, cautious re-engagement. Traders dipping toes back in. On-chain interest in Solana climbing again. XRP volume picking up. This is what you tend to see before a recovery phase, not before a collapse. And look, this doesn't mean you go all in. It doesn't mean we're calling the bottom. It doesn't mean things can't wobble again. But it does mean the recovery you're seeing today is consistent with every narrative thread we laid out yesterday. Liquidity matters. Mechanics matter. Macro matters. And when the noise settles, the structure is what tells you where the market is really sitting. As we start winding down today's episode, here's the message I want to leave you with. This market is fragile, yes. It's sensitive to news, yes. It reacts badly to thin liquidity, absolutely. But it also recovers fast when the selling pressure is mechanical rather than fundamental. Today's bounce doesn't erase yesterday's fear, but it gives us context. And when context returns, confidence follows. As always, we're going to keep watching the data, watching the ETF flows, watching Asia's reaction, and staying ahead of the narrative without ever adding unnecessary noise. That's what we do here. Make sure you're following the show so you don't miss tomorrow's update. Rate the podcast 5 stars if you haven't already. Drop "done" in the comments to get into the Friday XRP giveaway. And as always, we'll see you at the top.